Well. Good morning, everybody. Welcome to the state of the market. And we definitely want to talk about the state of the market. I think this is one of those pivot points I was talking about with Garrett, where I don't think you want to ignore some of the things that are happening out there because there's a pretty significant shift going on. Tim and I were talking about it last week. And I think things have gotten a little bit more concerning. So I'm not here to be a Debbie Downer. I'm here to sort of highlight some of the risks that perhaps are out there and some of the opportunities as a result that are out there. And for me, it's exciting, right? So I'm really glad you're all here today. I am, of course, Hans Albrecht, $1 billion in option strategies managed over many decades, too many decades, and option market maker, et cetera, et cetera. So before we dig in, I need to tell you about something happening tonight. We're hosting the first ever Pitties, and this one is for you guys. So if you've been part of the Option Pit community, as a member, as a viewer, as somebody who just keeps showing up, and we thank you for that. This is our way of saying thank you. So genuinely, we wouldn't be doing any of this without you. So sign up below. Someone's going to throw in a link in the chat. It's tonight, 7 p.m. Eastern. It's going to be a blast. We're gonna do it. We're gonna do it up. It's going to be like Hollywood Squares, and we're going to have a lot of fun and hand out some awards to people, well-deserving people, and give shout-outs all over the place. Okay, so what we're going to be covering today is we're going to be going through some charts first, right? Let's take a look at some of the important stuff that we're seeing out there, that I'm seeing out there. And then we're going to talk about where the concerns are, where the opportunities are. And I think it's really important, right? Tim and I have been watching something build in our signals and clearly on the charts. Something concerning if you look at the SMH today, if you look at Micron today, I added to shorts in both of those yesterday. It's a trading market, but there is a significant headwind now, and it's very important to talk about. I've been talking about this for months. About how people are going to be moving to open source. They're cutting costs. Remember token maxing? Well, they're token minimizing now. Microsoft cutting costs, Coin cutting costs, Uber cutting costs. OpenAI, I think, is actually going to be in trouble, and that's a big problem for markets. So let's take a look here. Tim, I want to bring you in. Tim, our esteemed head of macro, all-around wonderful guy, always interesting to listen to. Let's take a look at what we're seeing out there. Tim, good morning.
Hey, good morning, Hans. How you doing, buddy?
I'm doing very well. Thank you very much. And I'm kind of excited because I just talked about it with Garrett. We talk about mechanical flows sometimes, and I think they're very important to talk about because most people don't pay attention to this stuff. It's a bit of geeky derivative stuff, but we have so much money. I want to show you guys some of the risk. And this is kind of going to be one of the major topics here. Can you see my screen, Tim?
I think that's on a mean.
You didn't actually start sharing yet, Hans?
Okay, my bad. Let me click share screen. That'll probably help. That'll probably help a lot, I would say. Look, I'm the tech guy, but don't ask me to run your webinar. That's what we've got Dean for. He's the master. Okay, so let's take a look here. Semi ETFs are averaging 42 billion traded per day. So semiconductor ETFs, right? So we know the one big trade over the last few months has really been semiconductors. Yes, there's been broadening, and Tim and I have told you exactly where you can make money, and that's exactly where you've been making money if you've been listening. But semis have been kind of that sort of undercurrent that is really kind of lifting the AI space because there's a shortage of memory, all this stuff, blah, blah, blah. So we've seen amazing money move in. The biggest money 2 weeks ago was the biggest retail flow into semiconductors in that I think we've ever seen. That was not last week, the week before. And so it's worked, right? This has worked because we saw some of these record flows a month ago, and we saw the DRAM fund go from 100 million to 20 billion. And so this stuff has kind of worked. But my concern is that we really have a pretty sort of crowded boat here. One side of the boat is very crowded. We see in Korea, which is kind of the, basically 2 or 3 stocks kind of are a good chunk of that market. It's all about memory and semiconductors. We've seen leverage go up. We've seen money move into the ETFs. And as Garrett and I talked about, these 2-time, 3-time ETFs, they work very well because they have to reset on the way up, because when these stocks are doing well, they have to adjust their exposure, right? So they have swaps, things like that, different structures, but they have to, if semiconductors go up, they have to buy stock in order to give you the same performance tomorrow, right? If they don't add exposure to their semiconductor basket, they're not going to give you 2 times or 3 times the next day. And they need to do that on a daily basis. But it can go the other way. So if we start to see a little bit of a snowball go the other way, because it goes in both directions, the sword cuts both ways, right? Then we see the opposite effect, which is on a down 2%, 3% day, they have to readjust because now they're exposed. They have too much in the fund, right? So there's pretty simple math, which I'm not going to bore you guys with, but this stuff basically can go the other way. And all you need is a spark. So we call this gamma, without boring you guys with these crazy Greek names, and frat. And I think, I was in Phi Sigma Kappa. So we didn't have gamma in there. It's amazing I turned out to be an option trader, but Phi Sigma, well, Sigma's a good one. Sigma's, 1 Sigma is an important one. So maybe it's justified. But what this means is that we have things that move markets around. There are structural things that move markets around these days, and we have to be aware of those. And so this could really, what I was about to say is you need a spark, right? These things don't cause a problem until there's a story. What's the story? Well, that's what we want to talk about today, Tim, which is this sort of louder and louder conversation about OpenAI losing tons of money. Oracle, tons and tons of debt buying these things. There is a whole bunch of this build out that is really leveraged to 2 companies, OpenAI and Anthropic, which are spending boatloads of money and are losing boatloads of money. And now we've seen a movement into these other models. This didn't happen over 6 years. This is happening overnight. People are switching. Do you like to save money, Tim?
No. Of course I do.
Me neither. But what do you do when you can get something that's 85 to 90% as good, and unless you want the Apple label on it? But that's not what this is about. This is about getting performance for a lot less money, for 10% of the cost. And so
if you want to walk back one slide, we'll go over this. This is a really important thing for everybody to understand. This idea of these leverage ETFs. Again, like when we started trading, I remember being on the Amex. The Amex floor was the ETF floor, right? So like it's where they listed new ETFs. And I'm a kid, I'm 24, I'm on the exchange, and I've been on for 3 years, and they're ringing the bell because they got a new ETF coming out. And it was like, I don't remember what it was, but I thought, oh, finally. It was when they did the high beta and the low beta ETFs. They're like, oh, here's an ETF that's just all the high vol ETFs and all this. And I thought, finally, they finally listed the last ETF possible. They've created every possible ETF you can imagine. This is 2004. They've been listing ETFs for 20 years. I've been wrong for 20 years about the end of listing new ETFs because I just didn't have the imagination that we would have a need for these kind of things. I didn't see the value in them. However, when you see it, there are a lot of cool ETFs out there. They give you, they basically replaced all the mutual funds. But these things, these triples, these doubles, they're trading vehicles. They're not a place to put your money. You don't want to be investing in these things, but they add a new element to the market for trading that you need to respect. I don't like them. I don't really participate in them much. I know Mark is in there. He's trading some options on them. They give you a lot of juice when you want to get in there and trade. But they add flows, like you and Garrett were talking about. They add flows that are unnatural flows in a way that we have not happened and we've not had before. And so you have to respect the fact that, on a down day, you're going to get extra selling towards the close as they rebalance. And on an up day, you're going to get that extra pop.
Exactly.
And so it's just something that really, it's like another market player. Again, like the way I look at markets, the way I'm trading markets, I'm trying to track flows. And it's not necessarily I'm trying to track the flows of these ultra ETFs or the multiples of them. I'm trying to track real money flows, what's going through from different funds, where the themes are. But these products are throwing a monkey wrench in the system. I mean, they're just adding they're adding something. You just have to be aware of them and pay attention to what they're doing.
They're adding, and what's interesting about this is I've for many years now I've called this quite a different market. So you and I have done this long enough, me longer, and I remember when there was pretty good volatility generally all the time when things were busy. Now you really get what I call volatility clustering. So viewers, you know, if you notice that there are periods where it feels like we'll never get a downtick again. And then there are periods where the volatility just kind of keeps going and it's sort of relentless. And that's volatility clustering. It's either very high or it's very low. And if you're not adjusting quickly to a shift in the environment, it can be painful and you need to adjust very quickly. Otherwise, you can kind of get yourself into trouble. And so this is part of the reason is these sorts of things. It's $200 billion in covered call funds that just keep hammering out calls that loads up dealers with lots of positive gamma. And basically that slows things down. But what we're talking about today is look at where the leverage money is. Well, guess what? It's not in, do you think the leverage money is in, like Pepsi? No, that's not what people want to trade. They want to trade technology. They want to trade semiconductors. They want to trade memory. They want to trade mag. Oh, well, okay, there's some leverage in the Dow, a little bit in silver. This is inconsequential. This stuff is where there's already lots of volatility, but people want to go faster. So the flows that we talk about are exacerbated because this is what people want to buy. And this is where the tide turns and can go the other way for a period of time, because that's exactly where people have overdone it, and then it has to go the other way. So this is a bit of a concern right now, because what we really have is a market where we're starting to doubt a little bit. We've seen a number of shoes drop over the last few weeks, which is we saw Microsoft say we're cutting back on spending. We're seeing Meta. Meta was the big one. We talked about that on Thursday, didn't we, Tim? What did they say? They said we're gonna reconsider. Wait a minute. Meta just said we're going from a few months ago. Zuckerberg said we need nonstop compute. We're spending capex because it's going to get us to creating products that are great. We're going to keep on doing it. And then suddenly they go, oh, well, we've got a little bit too much compute. What does that mean? Well, maybe they've run out of ideas. Maybe they don't have a use for it. Maybe they see something behind the scenes that is suggesting that the demand for compute, while is still there globally. We know AI is going to expand, but have they overdone it? And what does that mean? So with this gamma stuff, I don't want to focus on this gamma too much, but my whole point is that, listen, gamma, which is the thing that pushes things around, is like a big pile of kindling. And all you need is a spark. You throw a spark in there, it takes something, and we may have gotten many layers of that something. OpenAI loses tons of money. Anthropic loses tons of money. What was their big win? Well, they're getting all the enterprise business. Now what are people saying? They're saying, don't frickin' run your enterprise through Anthropic or any of these things, because they're going to steal your IP.
Yeah. So, I think it's really important for everybody to understand here. We go through and we hammer on the stories, right? Because there's two parts to trading from my perspective, the way you do stuff. One is the story and the narrative that you have around each individual product, what's going on, the different sectors. And then you have the patterns. And again, you look at a chart and you're like, well, that's just a pattern. But the pattern, it's a fingerprint of what's going on in the market. So part of it is understanding the story and knowing sort of the narrative of what's going on, because that will shift behavior in terms of what people want, what do they want to have on. And then you look in the patterns of the charts, and they start to show you stuff that that you see. So, for example, this story that we're having a shift in that semiconductor space, that's step one. But then you start to see the flows, and you start to see the flows roll out of semiconductor space. And so that's what we're seeing. So if we take a day like yesterday, that semiconductors had a bounce, right? They bounced back up, and where we saw money coming out of was utilities. We saw them coming out of staples. We saw them coming out of healthcare. And I know this because I have this on. So this is the position I have on. I've talked about this for a couple of weeks now. I have a very small short hedge of short semiconductors, and then I have long all the other stuff. So it's this idea that we're going to have a reflation through the rest of the market. We're going to have a broadening. And so I'm long some healthcare names. I think we pointed out Gilead was one that I put out if you can pull the chart of that one up, that's breaking out today. It's up a good chunky amount. And the idea being you're getting flows out of this high beta meaning the high moving, sort of high growth kind of stocks into another area. So out of semiconductors and into the biotech space. We've been on this biotech, you pull up XBI. That thing is on fire. And that was a ticker highlight show, one that I put out. Then Gilead, CRISPR is another one breaking out. This is sort of, you understand what the narrative is, money flowing out of chasing these semiconductors, and it's kind of like become the ATM. They're going somewhere else. What we're seeing now is more of a rotation, and not necessarily, it's not a risk off. It's, if anything, it's defensive, but to me, I don't even think it's really that defensive. It's very much just a shifting of where are we going to put our money to work. And so the idea, 5 to 100, 125 positive. So net, the stocks are up. Most of the stocks are up today, with utilities, staples, energy, and healthcare leading. Real estate is even up a good amount today, but it's all coming out of semiconductors and tech. So what was concerning to me this morning is that I saw the IWM taken on the chin pretty quickly off the open. And when I see the IWM getting sold, that to me is a little bit worrisome, because that's, what is this really, are we having a risk off moment, or are we having a rotation moment? And I think that's important. And around the turns, when you have a turn like that, it is a little bit more difficult to figure out what is truly going on. But on a day like today, so yesterday I said the semis had a bounce, and the money went into utilities and staples, came out of utilities, staples, and energy, healthcare. Today, it's the reverse. So Samsung had a blowout earnings. And when you have a company like Samsung who has a blowout earnings, but the stock really can't hang in there, and semiconductors come off on a good earnings, that's kind of telling you, like we said before, it's priced to perfection. So you have semis off today, but breadth is up. Even with the market down, utilities, staples, energy, healthcare, banks, they're all doing well today. Like Berkshire Hathaway it's breaking out to new highs. There's stocks that are doing very well. Gilead sitting on the high right now.
Exactly, Tim.
Yeah.
So right now, it's and it has been lately. It's been a rotation. So we know that my main trading account's been hitting all-time highs, because I'm not in these areas that are in trouble. I'm in the rotation areas, in finances, in XLF, in a couple of the banks, KRE, some of the areas that are going to benefit from an expanding economy. And so you can see here that we've got the S&P in this triangle, probably ready to pull back a little bit. Depends on the thing is, and you talked about the rotation, and that's very important. Why you've got kind of a VIX of 16, because people look at the VIX and they go, well, nothing is really going on. There's no fear out there. Well, the fear is all under the hood because of what we talk about a lot, which is that dispersion. So if you look underneath the index, option pricing on individual names is actually very high, but the VIX will mask that completely because of the rotation. You've got some things doing well, you've got some things not doing as well, and it nets out to kind of nothing. And that's what the VIX cares about. It's sort of nothing. So the way they lay out is, and I agree with you, IWM is a very important one to watch, because it does sometimes crack. And what it always is a signal to me that this is now starting to get into the areas that were a little bit of the rotation, a little bit safer. So there are moments where IWM pulls back $20 if things get bad enough. So the way this can play out is, I mentioned this earlier with Garrett. I said, listen, this can continue to be rotation, which means a VIX of 16 to 18, but rotating into these other areas. Look at XLF yesterday. Look at your healthcares, your biotechs. Beautiful, beautiful charts. I'm starting to sell my ARKG too early. I have no doubt about that. But it's from the builders, which have all these questions now. Well, are they going to buy more? Are they pantry stuffing these memory chips? Are they, nobody's questioning AI being a big theme. The question is, where is the economic value in that? And we always have to keep in mind the flows. Are too many people on one side of the boat? So number one, we can continue to rotate, which is rotating into things and then out of these other things, and rotating into MAG. MAG could be a little bit of a safe haven in a sense, because they've been out of favor, and they're really the revenue generators. Whereas anything tied to the LLMs, the models, are the revenue losers. They do nothing but lose money. Anthropic and OpenAI may never make money. It's quite possible. So they're going to shift back into the companies that have been tried and true for many years. And they're going to say, well, cheaper compute may not be bad for these hyperscalers. So either we continue with the rotation, or this trade has gotten so big and the structure that we talked about earlier starts to create a little bit of a snowball where too many people need to get out. And then what that's called is a rise in correlation, everyone. So that means there's a little bit of contagion. Now, all percentage of this saying this is the other side of what could happen. We either rotate and things are okay if you're in the right place, or it starts to affect things, because when people start getting hurt in one place, what do they have to do? Well, they got to sell some of the stuff they did well on.
Yeah. And that's one of those things that and that's very much watching for that, because there is a difference between running for the exits and then just running to another place, right? And that's really, to me, I am hyper focused on what this rotation looks like and what it means. And so as long as I'm seeing flows into other high beta stuff, I'm pretty comfortable. I'm net long. I mean, I have very, very few shorts, but I'm sitting on that long. I'm watching where are the flows. Again, HYG and IWM, those are sort of your two canaries to watch. They track 85% of the time correlation. I don't know if you knew that, Hans, but like HYG and IWM are more or less the same exact product. They're just, one's a bond index and one is a small cap stock index, but they basically are one for one, 80 something high percent correlated with the beta kicker, right? So with the
Makes
IWM
sense.
being a lot higher volatility trend, but they're both based on growth and the credit cycle, or in sort of credit conditions. And when you watch both of them, you're getting you get that
money losing companies. They rely on debt. So it is, that makes sense to me.
Yeah. And so I watch those a lot. I'm watching to make sure, like, again, like I said, I get uneasy when I see the Russell being sold, but like this morning, the Russell is outperforming the NASDAQ, even, the downside, it's down less, when that's not necessarily on a risk off day. You should see that IWM
so strong that people just buy every dip, buy every dip. If this turns into sell every rip, I think this has the potential to get ugly. So look at Micron. It got to 1250. It's down to $900. Is that a cheap company? Whoa. Damn straight it is. It's nobody's disputing that it's a cheap company. But as we said, when you have hundreds of billions of dollars go into the sector and everyone's in, and there aren't too many people left to buy. Like I saw a guy on CNBC, he's like, I'm buying at $1,200. He's like, I just think the stock is cheap. Well, that's not what the stock market's about in the short term. And he may not care. He may say, well, in 4 years when I sell it at 2,000, that's all I care about. But as traders, this is a freaking crowd trade. I don't think this thing, I think it's got a good shot to get, and I said it's going to go 100, it could 800. And so I think this could be a bit of an issue if we don't find some support in the next couple of days, because we have an unwind that is very, very supported by a deterioration in the story, led by the Microsoft news, the OpenAI issues. They've delayed their IPO. Why have they delayed their IPO? Well, because their balance sheet looks horrible, and they may not have an exit strategy. And what did they do? They went and they said, hey, we're going to give the taxpayers 5%. Well, you know what that is? That's a freaking bailout. They said, we're going to give hey, we're so nice, we're going to give you guys 5%. Okay, so they enjoy the run from zero to $1 trillion valuation. And then they go, hey, taxpayers, why don't you take us on now at an $800 billion valuation? And now we all get to share in a gigantic money-losing company. So I don't want to be all Mr. Cynical or anything, but that's basically it. They're looking for a bailout at this point. Stand by that for now. We'll see how that unfolds. We have got some concerns in markets right now, and I think you just have to be aware of that when you're looking to buy the dips. As a trader, always a trade out there somewhere. As somebody with maybe a swing trader, a little bit longer term perspective, you want to be very careful. And we told you guys this last week, and here we go.
No, and I'm watching. So just basically I'm watching the S&P again. This little oil news. I'm not overly concerned with what's going on in Iran at this point. I think that is sort of in the back rearview mirror.
Great
Looking
point.
around, where the flows going, and right now I'm not. Again, this could change, but with the VIX where it is, with the rotation going through, the idea being find the areas where money is flowing into, and then that's where your trades are.
And that's why I like these charts. I know we're running up against it here, but here's a very long-term chart of software versus semiconductors. It's clearly been semiconductors all the way. We know this story. This is nothing new. But look, we're starting to push up here. I want to see these moving averages. Remember, this is a relationship. This is software versus semis. And so now software is starting to outperform a little bit. There may be some durability to that trade if the semiconductor trade is a little bit challenged and they start moving into something like this. So let's look at IWM to MAGs. This is a little less clear because MAGs are interesting to me. They have some benefits from the deterioration in the memory space, but at the same time, they also get a lot of revenue from OpenAI and these guys, right? So this is a little trickier, but I would say that IWM versus the MAG 7 is going to look interesting again very soon. So if we see some stabilization in IWM, I'm actually kind of interested. I'm starting to trim my mags just a little bit. I don't want to miss it. I think the meta news is interesting. It's going to put some of these mags, which are as cheap as they've been in years, in a whole new light, right? If people can't make money in massive money losing ecosystem, well, not money losing, the chip makers are doing great. If people can't make money there suddenly, they may shift into the old stalwart, make money no matter what kind of stocks. And especially if one of them comes out and says, well, we're going to reconsider our CapEx, holy smokes, is this going to absolutely change the world for them, but also the semiconductor trade could be risky. So all we're saying, guys, is there are a lot of questions, more questions than we've seen in a long time in the build-out space. They're even hitting GEVs and these build-out kind of names. There are a lot more questions than answers. Be very careful out there. I still love the broadening like Tim. On pullbacks, definitely interested.
Well, we got one thing. Again, I think you brought it up at the top of the show in case anybody missed it. We do have a very cool special event tonight. I'm excited for it. It is part of the reason that I'm here at Option Pit. It's this idea of a community. Look, I took time off to be home with my family for some years, and coming back to trading, I wasn't sure where I wanted to go. I didn't know what kind of company I wanted to be at, if I wanted to start my own again. And when Mark called me and said, hey, look, come on to Option Pit. We got a really good community. We got a good set of traders. And then we have a really cool base of customers. I view everybody sort of as a partnership. Tonight is a night where we're going to celebrate you. We're going to celebrate the Option Pit. We're going to celebrate the Option Pit community. And we got prizes. There's cash prizes going on. I think there's over 10 grand we're giving out to some of our best customers. In terms of your activity in the chats and how, I think there's something who's logged in the most, or I don't know exactly every single award, but there's going to be a good giveaway bag for anybody who shows up tonight. We have some good prizes there. I think we have some PDFs that we put together, and also there's a couple of cool other prizes they didn't want me to talk about it. But some surprise things. So tonight at 7 p.m. Eastern, it's going to be a great. I think you said Hollywood Squares. We'll all be there, and we're celebrating you guys.
All right, everyone. Pit Patrol, be there. It is going to be a terrific time. Make some time for it, and I'm sure we'll talk about some markets and some fun, mostly just fun stuff. We'll just go right to the fun stuff. And we look forward to seeing you there. And thank you so much for coming and watching today. We appreciate you every day. We love you all, and have a terrific trading day. Be hedged, be careful. And thank you, Tim. Thank you, Amin. And we'll catch you guys tomorrow.